Hi, I'm Christine Benz from Morningstar, and welcome to the How to Retire podcast. It's a companion to my book, which is also called How to Retire. Each episode will provide a bite-sized lesson about how to do some aspect of retirement well. Many of you know that I frequently talk about the bucket approach to retirement portfolio construction. I was inspired to work on bucketing after talking to Harold Evensky nearly 2 decades ago, and I knew that I wanted to chat with Harold for this podcast. He's the founder of Evensky & Katz Folds Wealth Management and a retired professor of practice of the Texas Tech University Personal Financial Planning Department. Harold and I talked about how he hit on the bucket strategy and used it with his clients. Harold, thank you so much for being here.
Well, thanks for inviting me.
Well, you had to be part of this project because you've been so influential in my work on retirement planning. I always credit the idea of bucketing a retirement portfolio to you. I want to talk about how you hit on that approach when working with your clients.
Was in the I guess a little later in the 90s, and I was working on my book, Wealth Management. And one of my issues has always been the myth of dividends and interest versus a total return portfolio. So I had established what we called our 5-year mantra, 5 years, 5 years, 5 years, meaning to manage this issue of sequence of withdrawal. And it simply meant that you don't invest anything that you're going to need 5 years or less. That needs to be liquid. So that was kind of the first step. The next was, how do we manage just sort of this issue, this sequence of withdrawal? And that's when a long time ago, so I don't really remember real well, but came up with this idea of setting aside some liquid funds so that as you were taking money out, my partner, my wife, Dina, referred to it as managing the paycheck syndrome. People retired, they're used in the past getting a regular payment. So setting aside an amount of money that they could set up, and whether it's Merrill Lynch or Schwab or Vanguard, any of them, they'll let you set up a monthly payout. So the idea was to put some money in there. Originally was kind of a backseat process. So I developed this. I said 2 years of reserves. And that's not all your expenses. That's just your really fixed expenses, like a mortgage, but not expensive trips or anything else. So if everything went wrong, you wouldn't have to dip into this total return portfolio. You wouldn't have to sell bonds, stocks, whatever. So that was the idea. The criteria was, it seemed pretty obvious to me, having worked with clients a long time, it had to be really simple and manageable. So that was kind of a beginning concept. From a behavioral standpoint, it was designed so the client wouldn't get panicked if the market was falling apart because they knew where their grocery money was coming from. So that was the underlying concept. Where do you get your grocery money and don't have to worry about it? Because we've always talked long-term, long-term, long-term. So it's a lot easier to get people to focus on that long-term when things are going wrong, if they can see where the grocery money is going to come from. So another, just for a fringe benefit, by carving that out, clients aren't paying for money that's sitting in cash. We don't bill against that reserve portfolio. So it was also a very efficient structure. The other sort of behavioral benefits, clients are much less to look to invest in gimmicks to give them, higher returns, whether it's junk bonds or, all the stories that are out there. And hopefully they wouldn't fall for the dividend and interest portfolio, that we can help them focus on total return. So that's kind of the history.
Yeah, that's helpful to hear about the behavioral aspect. So did you find that in kind of those market inflection points, say the great financial crisis, for example, did you find that this was beneficial in terms of actually keeping your clients in their seats during periods like that?
Now, I probably told you the story before, but the first and biggest test was October '87 crash. Um, like everyone else, I thought the world was coming to an end. I mean, it was just inexplicable and it was scary. Um, so Monday morning, um, we were in a very big office at the time, and I told my few associates, we got to get on. Oh, no, nobody called. That's what it was. So by 9 o'clock, I said, we got to get on the phone because they're probably all dead. Our clients, for the most part, were retired, very conservative. Well, the first person I got was a little retired widow, Miami Beach. Sounded like my grandmother. Val, what you want? And I said, well, you may have noticed the market was a little rocky. And she said, I know, 5 years, 5 years, 5 years. Long and short, across the board, it was a non-event. Not that anyone was happy with what was going on in the market, but no one panicked, nobody sold out. Next big test was the Grand Recession or the tech bust. It worked phenomenally well through all of those, market tests. So behavioral was and is really the overriding concept behind it.
Yeah. And then in 2022, when we saw stocks and bonds fall in the same year, I think the virtue of having liquid reserves as opposed to having that portfolio fully invested was really apparent to people, the value of having not just stocks and bonds, but maybe some other stuff.
The whole idea is we want everything totally invested long term. And again, that's our 5-year mantra.
Right. So you have experimented with ways to reduce that cash drag on the portfolio because, of course, there is an opportunity cost of holding liquid reserves. So you looked at standby reverse mortgages, some other ideas. Can you talk about that and sort of the benefit of not having too much in liquid reserves?
And the clear benefit is opportunity cost. And the primary way of managing that, again, we did along with my partner, John Salter, and my teaching assistant at the time, a much more sophisticated analysis. He concluded that 1 year was really marginally a little bit better. That combined with you're not putting all your expenses in there, just the ones that you really need to keep groceries on the table. And looking at the alternatives back in those days, the most popular thing was having a standby credit line. Well, that was great. Very, cost of it didn't cost anything if you didn't take it. The problem is, first time there really was a problem, the banks froze all those credit lines. I mean, it sounded good, but it just didn't work. And that's when I looked at the idea of reverse mortgages. And that was like an insurance policy, not something we told anyone to get. But if you ran through all that 1 year, as opposed to going into your total return portfolio, then you could turn to that. The fact of the matter is, we never had to do that, but that was just looking for belt and suspenders.
So a basic bucket structure that you talked about and used in your practice was just that liquid reserves plus a total return portfolio that you and the other advisors at your firm manage for clients. I have talked about a 3-bucket system where you've got cash, a high quality bond sleeve, and some equities. But I think you feel that maybe people get carried away with too many buckets. Can you talk about that and the potential pitfalls of having too many things going on?
To make it simple. When you have even the 3 buckets, how you go about continually managing that is not really a total return concept. Again, it's bifurcating what should be combined and thought of as a total. So I mean, that to me, that's the primary objection. And secondarily, it's very complex in managing that. You know, you're constantly kind of reviewing and having to monitor and justify and read. Then we talk about setting aside, a fourth bucket. I mean, that's really better have a better crystal ball than I have. Set aside funds for long-term care. Who knows remotely what that's likely to be when you may need it? It's just you're picking numbers out of the air. And then some real opportunity cost if you're keeping all of that, money just kind of in a liquid. So, no, apologies to everyone else who has much more complex and quote sophisticated systems. I don't think they make sense. No.
So I wanted to get you to reflect on your firm and your career retirement planning for clients, and maybe talk about where you feel in hindsight you added the most value for your clients. So there was investment selection and portfolio construction, tax planning, and then the behavioral piece. If you had to put your chips on one of those areas as the spot where you feel like you added the most value, which one would you say it was?
Yeah, I would really put it down planning. I mean, you have to start off with where's the money going to go? I refer to it as anchoring on the efficient frontier. The concept that for a given level of risk tolerance, there's a certain return you can expect to get. Well, how do we get to those anchors? We do that through the financial planning process. But that means looking at someone's goals and in detail, not just I want to retire and I want to live good. The goals need to be time and dollar specific, and then you need to prioritize them. And then you don't have one or two goals; you have a lot, and everyone is very unique. So merely rules of thumb make no sense whatsoever. So you've got your basic living expenses, your college tuition. Maybe you're taking care of someone. You want to take a big anniversary trip 2 years from now. So in our planning, it's not strange to have 10 or 15 goals. I probably have about 30. And plus, you're playing with who knows what kind of numbers anyway. But putting that in along with your risk tolerance, you can come up with a rational recommendation or solution as to what that portfolio will look like. Basically, what's the stock bond balance? So, I mean, all of that is overlaid by behavioral concepts. I mean, that's probably the single most important concept. I stumbled across that whole idea when I was doing my book, and became immensely enamored of the concepts.
Mm-hmm.
And
when you think about retirement planning, what do you think is the most underrated aspect?
I think acknowledging that it has to be based on really thoughtful planning, meaning taking all of these pieces that are unique to the individual into account. What are their goals? Time and dollar specificity, and then prioritizing. You may not be able to do all of those things. So part of our job as planners is helping people make those kinds of decisions. We can't do it for them. We can just help educate them. But, thinking of a sufficient frontier, if you conclude that, gee, I can invest in, 30% stocks and achieve all my goals, why would you want to do 50%? You want to change your goal if you think you want to take the risk and you're comfortable for your heirs or something. But other than that, you have your answer. If you can't do it, then we have to have this conversation of jokingly say you want to eat less well or sleep less well. You can't do all of this. And our general advice is you may want to think about eating less well, because if you say, well, yeah, I don't think I have a problem. I'll go up another 15, 20% in stocks. It's easy to say that when the market's going straight up. But as soon as that market has a major correction, everyone forgets it and, it's like, take me out to cash. I can't stand
Right.
it. No, so the real value we bring is helping our clients sleep well, achieve reasonable goals, not have to worry about their portfolio on a daily basis, but still understand where everything is and why it's there.
Are there any aspects of retirement planning that you feel like get way too much coverage in the discussion?
Focus on individual investments, whether it's the stocks you should buy or the mutual funds you should buy, and then adding insult to injury, all the gimmicky stories that are out there, the high risk, the investments people. I'm not a big fan of the flaky currency, the
Crypto.
crypto. Thank you.
Flaky currency.
I blocked that out. I'm not a big fan of it, but the fact of the matter is, I don't think I was going to say 1,000, probably 1 in a million investors even begin to understand what crypto is. But it's very attractive. And then, the stories out there, the dividends and interest income portfolios. I mean, I do this newsletter, and every month I have examples of this is a great income portfolio. I compare it to S&P 500. Terrible comparison. They never look good. Then you look at the Morningstar, the managers versus indices, and not Morningstar, S&P. Been going for decades that lucky if 20% beat the appropriate. That's the other problem, is misindexing or miscomparing. Say, wow, these funds beat the S&P for the last 10 years. Yeah, they invest in small cap growth. Give me a break. Bananas don't taste like oranges. That's not a surprise. So, but to me, those are the biggest problems out there.
Yeah.
So much nonsense. But they pay zillions of dollars in marketing.
Right.
They're successful.
You've been retired for a while now. What have been the biggest surprises during your own retirement?
As much as I love teaching and working with clients, I'm surprised at how little I sort of miss of that. How much I just enjoy being retired. So I think that's probably about it.
That's one thing I hear sometimes people step away from work and they do miss the identity that they had through their work. I'm sure you encountered that with clients. So what do you think makes the difference there?
Luck. I think I just am lucky. My personality is such that, I was passionate about it, spent many decades doing it, loved it. But when I was ready to go, pass it on to our next gen. And now I can watch what they're doing and be extraordinarily proud. I think we now have maybe 15 partners in the firm, which was both Dean and I, one of our goals, is have everyone have some equity ownership. From teaching, I think our firm now has 10 of the graduates of our program, and ones that while we were there, we cherry picked. So I mean, that's really rewarding.
Yeah, absolutely. Well, Harold, it is such an honor to have you here. You've been so influential in my own career. So thank you so much for your contribution today.
So thank you, and thank Morningstar. Y'all were a big part of what made us successful. So thank you very much.
Thank you so much, Harold.
Okay.
Here are the key takeaways for me from this conversation. The first is that holding some liquid reserves alongside your long-term portfolio can help you feel comfortable with the volatility of being invested in the market. Knowing that you can cover your expenses without having to tap your long-term portfolio can provide a lot of peace of mind. Another important point is that cash has an opportunity cost, and your cash bucket may not even outpace inflation. So don't allocate too much to it. 1 to 2 years worth of anticipated portfolio withdrawals is plenty. Finally, I often talk and write about a 3-bucket system and even a 4th bucket for long-term care costs. But Harold thinks a 2-bucket system is just fine. The point is to gravitate to an approach that makes intuitive sense to you and then stick with it. The book, How to Retire, goes even deeper on retirement investing and portfolio construction with experts like William Bernstein and J.L. Collins. Thanks so much for being here. I'm Christine Benz for Morningstar.